variable. Our third type of variance is the variable overhead variance. This is the difference between the standard variable overhead cost and the actual variable overhead incurred. Alternatively, this is the difference between the actual variable overheads incurred and the variable overheads observed. Variable overheads variance is equals to variable expenditure variance plus variable efficiency variance. Let's start with the variable overhead expenditure, which is given by actual variable overhead minus variable overhead absorption rate multiplied by actual labor hours. The second variance in our variable overheads is the variable overhead efficiency variance. It is calculated as variable overhead absorption rate into actual hours minus standard hours. Let's do an example. Our example requires us to calculate the variable overhead variance from the given information, which is standard cost per hour 8 shillings, standard time per unit 5 hours, actual production 220, labor hours worked 1,200 hours, and cost incurred 10,300 shillings. Let's calculate our example. First, we calculate the variable overhead expenditure variance, so which is given by actual variable overhead minus variable overhead absorption rate multiplied by actual labor hours. Our actual variable overhead, we given the cost incurred is 10,300 shillings, so it's 10,300 shillings minus our variable overhead absorption rate is 8 shillings, so 8 multiplied by actual hours, which is 1,200 hours, so we get 10,300 minus 8 multiplied by 1,200, it's 9,600. So 10,300 minus 9,600 is equals to 700. And because the actual cost is greater than the standard cost, we say it's advance, so it's 700 advance. Our second one is the variable overhead efficiency variance, which is given by variable overhead absorption rate into actual hours minus standard hours. Our variable overhead absorption rate is 8, which is 8 into actual hours. We have 1,200 hours. To get our standard hours, we'll multiply the standard time per unit multiply by the actual production, which will give us 1,100. So it will be 8 into 1,200 minus 1,100, which will give us 100, which is 8 multiplied by the 100. We get 800. And because our actual hours are greater than the standard hours, we say it's advance. So the variable overhead variance will be equal to the variable overhead expenditure plus the variable overhead efficiency variance, which will be 800 advance plus 700 advance will be 1,500 advance. Our fourth subdivision of variance analysis is the fixed overhead variance. Remember when we were subdividing, as we started the topic, we said we have three types. Like we have the material cost variance, the labor cost variance, and the overhead variance, where we said overhead as the variable overhead and the fixed overhead. So we've tackled the variable overhead. Now we are in fixed overhead variance, which is the difference between the standard cost of fixed overheads absorbed in the production achieved whether completed or not, and the fixed overheads attributed and shared in that period. Fixed overhead variance is given by the sum of fixed overhead expenditure variance and fixed overhead volume variance, which you can see we have fixed overhead variance is equals to fixed overhead expenditure variance plus fixed overhead volume variance. Let's start with the fixed overhead expenditure variance, which is the difference between the budget cost allowances for production for a specified control period and the actual fixed expenditure attributed and shared to that period. It is calculated as actual expenditure minus the budgeted expenditure. The second type in the fixed overhead variance is the fixed overhead volume variance, which is uh, the difference between the standard cost absorbed in the production achieved whether completed or not and the budget cost allowances for a specified control period. A fixed overhead volume variance is given by standard cost into actual production minus budgeted production per unit. Let's have an example of to calculate the fixed overhead variance as given in the screens. Calculate the fixed overhead variance from the information given. Standard cost per hour, which is 15 shillings. We have the standard hours per unit, 2 hours. We have the budgeted production, which is 400 units. We have the actual production, 360 units. Labor hours worked, which is 780 hours. And we have the cost incurred, which is 13,800 shillings. Let's give a solution to our example. Let's start by calculating the fixed overhead expenditure variance, which is given by the actual expenditure minus budgeted expenditure. The actual expenditure will be given, that is 13,800 shillings, minus the budgeted expenditure, which will calculate the budgeted expenditure, which will be the standard hours per unit multiplied by standard cost per hour multiplied by budgeted production. It will be the standard hours per unit is 2 hours multiplied by standard cost per hour, which is 15 shillings, multiplied by the budgeted production, which is 400 units, which will give us 12,000. So it will be 13,800 minus 12,000, which will get 1,800. And because the actual cost is greater than the standard cost, that will be advance. So we will have 1,800 advance. The second one in the fixed overhead variance is the fixed overhead volume, which is given by standard cost into actual production minus budgeted production per unit. In our example, the standard cost is 30. Standard cost is 30, which will the 30 will be calculated as standard cost per hour, which is 2 multiplied by standard hours per unit, which is standard cost per hour, which is 15, and multiplied by standard hours per unit, which is 2, to get the standard cost, which is 30. So it will be 30 into actual production is 360 units minus the budgeted production, which is 400 units. So the difference will be 40 So it's 30 multiplied by 40 to get 1200. And because the standard cost is more than the actual cost, we say that's favorable. So it will be 1200 favorable. So our fixed overhead variance will be fixed overhead expenditure plus fixed overhead volume variance, which will be 1800 advance plus 1200 favorable, which will give us 600 advance. That's all about variance analysis. If you have any question, any comment, please comment in the comment section. And if you have anything you want us to cover more, please comment in the comment section. And for now, enjoy the variance analysis. And thank you for watching this video. Till next time, continue subscribing, continue liking, and press the notification bell so that every time I upload a new video, you get to be notified. And for now, we say bye.